What is a health insurance credit? Well, for the years from 2010, so it actually goes back to the beginning of 2010, through 2013, qualified small employers can claim a non-refundable credit for health insurance premiums they pay for their employees. Now, this insurance credit offsets the regular income tax that you would pay, and also the DMIN, the alternative minimum tax, or as we lovingly call it, the AMT. So it'll offset both of those taxes, which makes it a very valuable credit. Just a word about credits. This is a tax credit, which means that it offsets your bottom line federal taxes dollar for dollar, compared to a deduction. If it were a deduction, it would reduce your income that's subject to tax. So if you were in a 35% tax bracket, a deduction would only save you 35 cents on the dollar, where this credit will save you a dollar on a dollar. So it makes it very valuable and something you really need to look into if you qualify. So the health insurance credit is a credit of up to 35% on the lesser of the employer's contribution to a qualified health insurance arrangement for your employees, or the amount that would have been contributed based on the premium from the average health insurance premium for the small group market that you're located in. You know, this is tax law, remember, so nothing's ever simple or straightforward. One word of caution, this credit, if you do get a credit and claim it, you have to reduce your health insurance deduction by the credit amount. So what I told you before is not exactly true with this credit. It doesn't offset your taxes dollar for dollar because you have to add the credit back to your income. So if you're in a 35% bracket, you know, you're really going to save 65 cents on the dollar for this credit. Still a lot better than saving on a deduction 35 cents on the dollar. We've reproduced the average health insurance premium for the small group market for 2010. This is information that was put out by the federal government, and it's done state by state. So if you can read this thing, if your eyes are better than mine, you can see in California, for employee-only coverage, they say that the average premiums are $4,628 per year. For family coverage, it would be $10,957 per year per employee. So that's what the federal government thinks is the average for our area. I'm sure Phil would say those numbers are probably not super accurate, but those are the numbers that we have to utilize in calculating this credit. So remember what I said before, it's a lesser of what you actually pay in premiums or the amount that comes off of this chart. So let me just show you a quick example here. Let's say we've got Todd. He's running a business in California, and he's paying 75% of the premiums for family coverage for his 8 FTE, stands for full-time equivalent employees. And so his employees are paying the remaining 25%. The premiums considered for the credit are the lesser of 75% of the actual premiums paid, which is what Todd's actually paying. He's paying 75% of the premiums, or $65,742. How did we get that number? We looked at that chart that I just went over. Remember, California, the family coverage was $10,957. We would take 75% of that number, because that's what Todd is paying for his employees, and multiply it by the 8 employees that he's paying premiums for to get that $65,742. So it would be the lesser of the two, what he actually pays or the amount off of this chart. Now, who is a qualified small employer? There's 3 hurdles that you have to get over here. The first one is how many employees do you have? The law allows you to utilize this credit if you have fewer than 25 full-time equivalent, that's the FTEs we call them, employees during the year. So how do you figure this out? Well, what you do is you take the hours that your employees actually work, and you do not include overtime hours, so it only goes up to the maximum for a year under, for normal hours, which is 2,080. So you add up all the hours that your employees work up to 2,080 hours, accumulate that number, and divide it by 2,080. That gives you the number of full-time equivalent employees that you have. If that number equals or exceeds 25, then you're not going to get any benefit from this credit. And now a couple things that are excluded from this calculation. You do not include owners or family members of owners, which is extremely beneficial and makes this a usable credit, because a lot of owners would take you over the next hurdle. Also, you exclude seasonal employees, which are employees that work less than 120 days. And so you exclude those from these calculations also. So that's the first hurdle. Do we have less than 25 FTEs? The second hurdle is we have to pay them average annual wages of less than $50,000. So once again, what we do is we add up all the wages for these employees, excluding the owners and their family members. We add up all those wages and divide it by the full-time equivalents that we calculated under the first hurdle that we had to get over. And we come up with the average annual wages that we're paying our employees. And that has to be under $50,000 to qualify for this credit. So those are two hurdles. The third hurdle is the employer must be paying at least half of the premiums for their employees for health insurance coverage, or under a qualified health insurance arrangement, which I'll explain in a minute. Once again, owners and their family members are excluded from these calculations. So what is a qualified health insurance arrangement? It's an arrangement under which the employer pays premiums for each employee that is enrolled in health insurance coverage that's offered by the employer. The contribution that the employer makes must be an amount equal to a uniform percentage, which has to be at least 50% of the premium cost of the qualified health plan. That's a mouthful. Now, there is an exception. Once again, as I said, this is tax law, so we love exceptions and stuff. There's an exception carved out for 2010 also. The reason being is this thing was passed during 2010, but it was effective back to January 1st of 2010, so they felt they needed to carve out an exemption for 2010 only. And that exemption says that as long as you as the employer pay an amount of at least 50% of the premium for single employee-only coverage for each employee that's enrolled in your retirement plan, or in your insurance plan, then you'll be able to take advantage of this credit, and you will satisfy this uniformity requirement, even if you're not paying the same percentage for each employee. So that's for 2010 only. You only have to cover what would be 50% of the single-only coverage. So that's a big break for 2010. Now, only premiums paid to a health insurance issuer account. This is, you have to pay health insurance to an issuer that's licensed to provide insurance in your state. If you're self-insured, that does not count. You have to be paying premiums to a health insurance issuer. Okay. In addition to major medical coverage, there's other coverage that can be counted towards this credit. And each different type of coverage, really, you do the calculations separately. So you'd look at each of these as a separate calculation to see whether or not you meet the uniformity of coverage requirement. That's that 50% criteria that I pointed out before. So some other areas that you can look at to see if you can take a credit on the premiums you paid are limited scope dental or vision coverage, long-term care, nursing home care, home health care, or some combination of those. Coverage for a specific disease or illness only would qualify. Hospital indemnity or fixed indemnity insurance for health would qualify. And then also Medicare supplemental health insurance will also qualify. So these are separate types of care that you do separate calculations as far as coverage is concerned. So that's sort of the qualification stage. Now this credit, you know, is at 35%, but it's phased out for certain employers, and there's two different phase outs that we have to look at. Okay, and the first one is if you have more than 10 full-time equivalent employees, then there's going to be a reduction to this credit. Remember, I said you had to have less than 25 to qualify, but between 10 and 25, we're going to reduce the credit. The reduction is calculated, and I'll go through an example of this at the end. The reduction is actually calculated by multiplying the credit by a fraction, the numerator of which is the number of full-time equivalent employees you have in excess of 10, and then you divide that by 15. So once you get to 25, you're excluding the entire credit. Okay, so that's the first phase out for more than 10 full-time equivalent employees. The second phase out is if your average annual wages that we calculated earlier, if it exceeds 25,000, then once again we're going to phase down this credit. In this case, the phase down, once again, we take the actual credit that we have and we're going to multiply it by a fraction of which the numerator is the average annual wages in excess of 25,000 and the denominator is 25,000. So once again, when you get to 50, you're going to eliminate the entire credit. Now, if you're an employer that has more than 10 full-time equivalents and average annual wages more than 25,000, then you're going to reduce this credit by the sum of these two reductions. But you don't go below zero. You know, this is a credit. It may take you down to zero, but you don't have to pay anything back if you don't qualify. So let me take a look at an example here because it's a little confusing and probably convoluted here. So here we have Jill in 2010. She's a qualified employer, so she's met the other requirements, but she has 12 full-time equivalent employees and average annual wages of $30,000. So she's over the 10 full-time equivalent employees and she's over the 25,000 annual wages. So she's going to have to reduce her credit. She paid $100,000 in health care premiums for those employees, and the premiums that she's paid is less than what she would have paid based on that chart that I showed you earlier, the small group market chart. Okay, so we're going to say the whole 100,000 is qualified for this credit. So here's how we would calculate the credit. We would take the 100,000 of premiums paid, multiply it by 35%, which is the credit amount, the credit rate, and we get 35,000. First reduction is for the excess employees over 10. She has 2 employees over 10, so we're going to reduce it by 35,000 times 2 divided by 15 would give us a reduction of $4,667. The second reduction is for the average annual wages in excess of 25,000. Again, she's at 30,000, so she's 5,000 over that limit. So we're going to reduce the 35,000 by a factor of 5,000, the excess wages divided by 25,000. So that is going to calculate out to a $7,000 reduction. So our net credit for Jill for last year would be $23,333. The $35,000 original credit, less the excess employee credit, less the excess annual wage credit, gives us $23,000. So $23,333 is the amount of credit that she could claim on her return. Once again, remember, she'd have to reduce her health insurance deduction by this $23,333 because she's getting a credit for it. We cannot double dip on this. So in conclusion,